Hi, I'm Ken Frier, Chief Investment Officer of Atlas Capital Advisors. This video on venture capital investing is part of a series we call Alternative Investment Reality Check. Many investors believe that alternatives are a good way to raise returns and the diversification of their investment portfolios. As we'll demonstrate in this Reality Check series, on average over the last decade, alternatives have not achieved those objectives. So let's turn to venture. Investments in venture capital have been growing rapidly. As this chart shows, there's 1.2 trillion invested and committed to US venture capital, which is triple what it was 6 years ago. The main reasons investors have been attracted to venture capital are there's the possibility to invest in startup companies which are unavailable in public markets. If you happen to invest in the next big winner like a Google or a Facebook, then there's the possibility of spectacular gains. Venture investors expect to obtain higher returns than in public equities. And moreover, there's a perception of a diversification benefit. Despite these potential advantages, in recent years, venture capital has not lived up to its promise. Venture firms report investment outcomes based on the internal rate of return, or IRR. IRRs are often misleading and they typically exaggerate true performance. But even if exaggerated, the long-term returns of venture investing have not been better than similar lower-risk public market indices. Venture capital investing is highly risky, at least 50% more risky than investing in public equity, and therefore a fair return on venture investing should be higher than the return of public equity indices. But in fact, venture investors have not been compensated for the risk they take. This chart shows in blue the 10-year annualized return through 2023 for venture capital investing from 3 different sources. It also shows in green 3 public market benchmarks. We can see that venture capital returns have been lower than the return of the NASDAQ 100 or of the S&P 500 information technology sector. Venture returns have also been lower than the FTSE Russell Venture Capital Index. That's an index which attempts to mirror the sector and risk profile of venture investing through making investments in public equities. The fees paid to venture capital managers are a big obstacle to achieving attractive returns. Venture capital managers typically charge a management fee of 2% of assets, and in addition, 20% of the investment return, and some charge even more. As this chart shows, a venture manager would need to have earned a gross return of 21.3% to deliver a net return of 15% per year over the last decade if they had fees of 2 and 20. That gross return of 21.3% would have been higher than the returns of the public equity indices, but the 6% per year lost in fees leaves a net return to be below the public equity indices. Moreover, if you invest in venture through a fund of funds, then you'll pay another layer of fees like 1 and 10. An investor who had both layers of fees would end up with a net return 2.5% lower still, or 12.5% down from the gross return of 21.3. So it can often be the case that although your venture manager has skill, the impact of these fees is significant enough that net of these fees, the limited partner ends up with a return that's lower than the return of public equity. One negative influence on the long-term outcomes of venture investing is the pro-cyclical timing of capital calls. We can see from this chart of capital calls by year that capital calls were elevated during the innovation company frenzy in 2021, just as they were elevated at the end of the tech bubble in 2000. Because venture firms tend to invest the most at the worst time, the average return on each dollar invested is lower than it would be if a more steady amount was invested over time. The hangover from the surge in venture investing at the end of the tech bubble lasted for years, and the hangover from the 2021 surge is ongoing. For each venture-backed company, the goal is to reach a successful exit where the value of the company is realized. The number of successful exits and the value of distributions has shrunk meaningfully in recent years. As this chart indicates, IPOs of venture-backed companies were scarce in 2022 and in 2023. The more common exits through strategic or financial buyers also went down significantly. We can do the math. There are more than 50,000 venture-backed companies in the US, and there's more than 1,000 added every quarter. And yet in 2023, there were 1,000 exits of any type which occurred. And in fact, in 2023, the portion of venture investments which were distributed back to investors was just 6%. And that's the lowest distribution yield in any time since the global financial crisis. Many investors also believe that venture capital provides a diversification benefit, but this is an illusion based upon the way venture capital returns are reported with smoothing and a lag. In reality, venture capital investments are in smaller companies that have a high risk of failure, and so the risk is higher than for the more established companies which are listed on the stock exchanges. Some investors, like the large university endowments, have managed to succeed as venture capital investors since there's a wide dispersion of outcomes. This chart shows for the vintage years 2011 through 2020 the distribution of IRRs. So the investors with the best chance to succeed would have very experienced, well-networked specialists who can identify potential top quartile venture firms in advance and are perceived as being a desirable limited partner by the general partners. And that might not describe you or your advisors. So to sum up this video, on average, net venture capital investment returns have been below the returns of public equity technology indices. In part, this is because the high fee burden has detracted from venture outcomes. Venture firms, on average, have been pro-cyclical investors, which detracts from the long-term track record of venture investing. At present, there are severe liquidity strains in the venture ecosystem, with a mismatch between the large and growing population of venture-backed companies and the small, shrinking amount of exits. Success in venture investing requires organizational capabilities and access that, for the most part, are not available to individual investors or their advisors or representatives. So thank you for listening. You may find more research about alternative investing on our website, atlasca.com. You may also email us at info@atlasca.com. Thanks.